In this video, I'm going to talk a little bit about cost behavior. The definition of cost behavior is cost behavior refers to the manner in which a cost behaves in relation to a related activity, right? So how do costs behave, for example, as we use more machine hours? How do costs behave, for example, as we produce more units or we sell more units and so forth? Those would be examples of activities, right? And you can link these activities to the cost, because these activities tend to drive costs. The more you produce, the more costs you're going to have in certain areas, right? The more machine hours you use, the more costs you're going to have in other areas, say for example utilities expense and so forth. So so when you talk about cost behavior, you always want to relate it to an activity within a relevant range. What that means is within a range in which that's not at two extremes, because at extremes behaviors tend to change, right? So within a normal range, we could say certain behaviors behave in a variable manner, others behave in a fixed manner, and others behave in a mixed or semi-variable manner. And what do we mean by that? Variable costs are costs that increase as the activity increases. So they go up with the activity, right? So let's say, for example, you produce more inventory. You're a manufacturing company and you produce more inventory. Are you going to use more materials? The answer is yes, right? Or if you sell, you're going to recognize more expenses in materials sold as cost of goods sold, right? So materials is a good example of variable cost, because it will go up as you sell more or as you produce more, however you want to put it. An example of a fixed cost is a cost that stays pretty much flat, regardless of how much you produce or sell, or whatever the activity it is that you're linking it to. In my examples, let's just use units produced, just to make it simple, or units sold. So if I sell X amount of units, it's not going to increase my expenses at all under the fixed behavior. For example, let's say I have factory rent, and my factory rent is $10,000 a month. That is not going to change regardless of how many units I produce or how many units I sell. It's going to stay flat at $10,000 a month. That's why it's called fixed. So it stays flat. On the other hand, if I sell or produce 5,000 units, let's just use the word sell, the activity sell, and we'll recognize the expense as cost of goods sold, right? If I sell 5,000 units, I will recognize X amount of direct materials as part of the expense. If I sell 10,000 units, I'll probably recognize twice as much, right? Because I have sold 2 times the unit. So these variable costs will go up proportionately to the activity. In this example that I just finished giving you is units sold. Okay? So here we go. Mixed or semi-variable is a combination of both. It's something that typically behaves in a fixed manner initially, and then will go up. So a good example would be something like the usage of your data in your phone. Your phone company may charge you a fixed rate for the month, and after you go a certain usage, then they will charge you by, I don't even know the terminology, gigabytes used or something like that. So at that point it becomes variable, because as you use and consume more of the data, you will pay more and more. So that would be mixed. Mixed starts off flat and then starts shooting up once you hit a certain threshold. For almost all of these examples, we're going to just limit ourselves to variable and fixed. Now, recognizing what is variable and what is fixed behavior is very important in managerial accounting. Many of the analysis that we do require us to understand what are our variable costs and what are our fixed costs. It's extremely important. Before I move on to that, let's just continue with the cost behavior. Let's take a look at an example right here. So it says here, examples of variable costs, materials used to manufacture products. Labor used is an example of variable, and all these are, both of these are part of inventory if you are a manufacturing company, right? If you manufacture the product. And when I talk about labor use, I'm talking about direct labor. So if it's the employee that puts together the product, let's say for example you're assembling a guitar and there's an employee that cuts the wood and there's an employee that glues it together and puts it together. Those two employees are touching the product, and that's known as direct labor, and we're just going to assume that those employees are paid, for example, by the hour or by units produced. So as I produce more units, typically that cost is going to go up. That's why it's known as variable. Electricity is also variable, right? The more you produce, the more electricity you're going to consume. I forgot to put examples of fixed, but examples of fixed, I guess I can type them in right here. Let's get some examples of fixed. And so examples of fixed costs would be things that don't go up, like rent, right? Whether it's corporate or factory rent, it's typically going to be stable. Doesn't matter if you produce or sell 1 unit or 1,000,000 units, you're typically going to pay the same amount of rent, right? Insurance is also something that is predetermined, and you're going to pay a certain fee regardless of how much you produce, how many units you produce, or how many units you sell. So you're going to pretty much pay the same amount of insurance within that range. Okay. Let's see some other examples. Oh, some salaries are also fixed, right? Supervisors are typically paid a fixed salary. Okay. So if you want a chart depicting a lot of the fixed, not all of them, this chart is not all inclusive, but a lot of the fixed and variable costs, you can look at the chart that I have uploaded in Blackboard. This shows you divides it into product costs and period costs. Product costs are the costs that are capitalized into the inventory, and period costs are expensed immediately, okay? And they hit the income statement immediately. So these costs, these product costs, we go ahead and capitalize them and we put them in the inventory until we sell it. And then when we sell it, we recognize it as cost of goods sold. So among those costs, we have direct materials, right? That's a variable one. Direct labor, as I said, those are the people that cut and assemble the guitars. That's variable. Within the factory, we have various variable expenses. Things like miscellaneous materials like glue. We have oil used. We have heating and lighting the factory. All these things are going to go up the more we produce, right? And the more we sell. Some things that are fixed that don't go up regardless of how much activity we have are things like property taxes, insurance, depreciation on equipment, and what we call indirect labor, factory production supervisor, and so forth. That's on the product side. On the period side, we have selling and administrative expenses. Okay, remember these are expensed immediately. They hit the income statement as an expense immediately. These are capitalized into the inventory. In other words, you shift these into inventory, and eventually you sell them. Once you sell them, you recognize the expense as cost of goods sold. And there's a video that explains this. It's the title of the video is the cost flow process, or something to that effect. Okay, so take a look at that video for a better explanation. But anyways, here you see that there's various variable and fixed types of costs, okay? So that's cost behavior, and let's continue with this example. For example, if it takes $3 to produce an item we sell for $5, and we lease a machine that costs $60,000 a year to lease, then the cost behaves in this manner, okay? If, and I put $60,000 a year, but I'm showing 5,000 here, so you know what, let me change this then so that it could match. I think what I did was I divided this by 12, right? This is a monthly and this is a total, but let's just make it match. Okay, let's make it match over here, 60,000. Okay, so if I produce 100 units, my total cost, which is variable, goes up, right? It's going to be $300 because each unit is going to cost me $3 to produce. If I produce 500 units, each unit will cost me $3 to produce, and so my total cost is going to be $1,500. If I produce 1,000 units, my total variable cost is going to be $3,000. So as you can see, this cost goes up as I produce more units. As opposed to the fixed cost. The fixed cost stays flat. It doesn't matter if you produce 100 or 1,000, you're still going to have a total cost of $60,000. And it doesn't even matter if you produce 0, right? If I produce 0 units, let's go ahead and format this. Let's give it a similar format. Okay, so if I produce 0 units, the unit cost is going to be $3, right? But you produce 0 units, so you're going to have 0 variable costs. Over here, you're still going to have $60,000 in fixed costs. It doesn't matter. This is always going to be fixed. Why is this important? Well, so many of the decisions that we make in managerial accounting, whether it's to make or buy a product, whether it's to give special pricing, whether it's to get rid of a segment or keep, or get rid of a product or keep, involves understanding cost behavior. It involves understanding which costs go away and which costs stay. Typically, because variable costs are linked to the product, if you do not manufacture the product anymore, you don't incur the variable cost. Fixed cost is something different. You may not be able to get rid of all your fixed costs. Sometimes these are agreements that you're stuck to for many years. So you have to analyze how much of this fixed cost you have to get rid of before you make that decision. Let me give you a very simple example of an analysis that requires understanding variable versus fixed costs. For example, the break-even analysis, okay? And now because I changed this to 60,000, now I have to now I guess I have to change all this. Let's see if it adjusts automatically for me. It makes my life easier. Okay, so it did not, but that's okay. I'll fix it as I go. Okay, and this is going to change, right? And I'll fix it when we get there. Okay, so break-even analysis requires understanding your fixed costs and your variable costs. Okay, so I know that my fixed cost is $60,000 here, right? If I sell an item for $5, it does not mean that I get $5 for every item that I sell on a net basis. Why? Because it cost me $3 to produce that item, right? So on a net basis, I get to keep $2 for every item that I sell to contribute to cover my fixed costs. After it covers my fixed costs, then it goes down to my bottom line, income from operations or net income, whatever you want to call it, right? So if my sales price is 5, my variable cost is 3, every unit that I sell gives me $2 to contribute towards fixed costs. So how many units do I have to sell to break even? Well, that's very easy to calculate once you have divided your costs into fixed and variable. Total fixed cost is $60,000. How much does each unit contribute? Each unit contributes $2. I sell it for 5, but it costs me $3 in an incremental variable cost to produce that unit. So I get to keep 2 to cover my $60,000. $60,000 divided by 2, if my math is correct, is 30,000 units, right? So I must sell 30,000 units to break even. Okay, this is a very simple analysis just to emphasize the importance of understanding how to, why it's important to understand the cost behavior of your different costs, right? Without understanding it, it's impossible to do such a simple analysis like a break-even analysis. And it's also impossible to do other analysis, okay? So there's going to be other videos that are linked to cost behavior. We're going to explain absorption versus variable costing. And as I mentioned a little earlier, I am also going to explain a little bit on the cost flow process, okay? So, thanks.